Hey students, this is Professor Hankinson and this is Accounting 1100. And in this video, what we're going to be doing is we're going to be reviewing some problems that are similar to those that are going to be in your final exam. So the first one we're going to start out with is in chapter 5. And in chapter 5, we talked about revenue journals and different types of ways of recording transactions. So in this problem, what it's wanting you to do is it's wanting you to look at each of these following 5 transactions of Porsche Creations, and using the revenue journal, it wants you to record the information. So this is pretty easy. First of all, what it's going to asking you is to enter the invoice number. So if you look up at A says on March 20th, and this is definitely the line for March 20th, it said Porsche sold 35 cell phone covers to Extreme at $5.50 per cover, and it was on invoice number 887. So the first bit of information we're going to fill in is going ahead and that invoice number 887. Now the next thing it's asking you is what account is debited. So let's think about this. This is our revenue journal. And what we're recording on a revenue journal, this is basically our accounts receivable subledger, if you think about it. So all of these transactions were sold on account, okay? We know they were sold on account because they were sold using an invoice. So we need to update and record each of these transactions so that when we pull up the accounts receivable subledger for each individual customer, then the amount they owed us is going to be reflected. And that's what we're doing right here. We're updating that information to make sure that we have the most up-to-date information on all the customers that owe us money for their invoice. So what we're debiting, we are debiting accounts receivable. So if you look right here, it says right there, we're debiting accounts receivable. What are we crediting? We're crediting, we have already credited fees earned. Fees earned is a revenue account. So this is definitely, we're making sure that we're keeping up and keeping track with all of our revenue transactions, and also posting to the accounts receivable subledger. So when it asks what account is debited, when you click on the drop-down menu, what you see here is you have each of the different customers' names. So you're going to go up there to letter A, and you're going to see that the customer we sold the cell phone covers to was Extreme. So that's the accounts receivable subledger account we're going to debit, okay, which is Extreme. So if you remember, each customer has its own accounts receivable subledger. Okay, again, that's to keep track of what customer owes us what money. All right, and next thing it's going to ask us is it wants us to put in the amount. Okay, and the amount's simple. You're going to take that $5.50 up here, the $5.50, and you're just going to multiply it by the total number of cell phone covers. So 550 times 35 equals $192.50. And that's it. So we'll do one more. On March 24th, Porsche sold 15 cell phone covers, all right, to Sidekick for $8.50 per cover. And they did that on invoice number 908. So let's go ahead and record invoice number 908. Select Sidekick, that's the customer we sold it to. And we'll take 15 times $8.50. And that's going to equal $127.50. All right, so I'm going to go ahead and click on this. And if you see here, we'll go ahead and we just just went ahead and finished it out so that you can see all the answers. So if you just look at it, we just March 22nd, brought that information, entered it, did the math, 5 times 33 equals 165. March 26th, brought that information down, did the math of $4.50 each for 220 cell phone covers, and that equaled $990. And then the last one, March 29th, 15 cell phone covers at $875. Do the math, is $131.25, and the customer and the invoice number. So it's simple, it's easy peasy. So that's all you're going to do on that first problem. Okay. So on the next problem is wanting you to look at this specific customer account. So this is a subledger of accounts receivable specifically for the Boogie Board Waterware account. And we are looking at the transactions And it wants us to just describe each transaction and the source of each posting. Okay, so let's look at that first one, July 6th. All right, that is the first transaction it's wanting us to describe. So before we do that, I want us to take note of something. What we have here is we have a date, we have an item, we have a post reference, we have an amount debited and an amount credited and a balance. All right, so in the beginning of July, we started out with a balance of $884. Okay, on July 6th, we recorded invoice number 406. All right, our reference number, that R means this came from the revenue journal. All right, and we debited the customer's account, the accounts receivable account, okay, $921. So it came from the revenue account. Revenue is always recorded with credit. We know this. All right, and we're seeing here that it was a debit to the customer's account. All right, and the customer's accounts receivable. So this first clue tells me that on July 6th, we sold $921 on account to Boogie Board Waterware. All right, because our post reference is Revenue Journal, page 42. That's what that R42 stands for. And we debited the customer's account, which is an accounts receivable account, $921. When you debit accounts receivable, you're creating receivable. You're recording an amount that customer owes you. All right. And it increased our accounts receivable balance for the account Boogie Board Waterware to $1,805. Okay. So that tells me right there, we sold $921 on account to Boogie Board Waterware. All right. So let's talk about the next transaction. All right, so let's get the next transaction on July 24th. We have an invoice number for reference. And then when our post reference is CR, that's our cash receipt. CR, cash receipt, page 56. All right, and we see here a credit of $884. So if we are crediting the accounts receivable account for Boogie Board Waterware, then our debit was to the cash. So if we're debiting cash and crediting accounts receivable, then this is a payment. This is a payment we received. Okay. And if you look up here, we had a beginning balance of 884. So what this tells me is on July 24th, Boogie Board Waterware made a payment to pay off the balance that they had with us prior to July 1st. So on July 24th, cash of $884 was collected from Boogie Board Waterware. So we just come here and check our work. There we go. So that's all this problem right here is talking about. All right. So let's move on to the next problem. All right. Now, what we're looking at here is Travis Company. Okay. Travis Company purchased some merchandise on account. And they purchased it using the terms 210 net 30. Okay, so that 210 net 30 tells me that it's due within 30 days. However, if they pay within 10 days, they'll get a 2% discount. Okay, so Travis Company paid for the merchandise within the discount period. Using the perpetual inventory system, journalize these transactions. All right, so the first thing we're going to want to do is we're going to take that $5,400. That's how much they purchased on account. That's $5,400. And we're going to multiply that by 2%. All right. So 2% of $5,400 is $108. All right. So that is our total discount. So we're going to take 5,400 and we're going to subtract out 108. So the amount that we are going to purchase our inventory for is $5,292. All right, so let's start doing our journal entries. We have the amount. So again, like I said, you take the 5,400, multiply it by 2%. So our total discount is $108. You take the $5,400 and subtract out 108. And the amount that you'll owe is $5,292. Okay, that's the discounted amount. So we need to first do our first transaction. Our first transaction is to record the fact that we purchased inventory. Inventory is an asset. Assets are always increased with a debit. If we're buying inventory, we're increasing our inventory. And again, inventory is an asset. So to increase our inventory, we do it as a debit. So here we are, $5,292 debit entry to our merchandise inventory. Now we bought it on account. If we bought it on account, that means we created a debt. Well, what account do we use to create a debt? We use liabilities. Liabilities record debts. All right. So let's do our drop-down menu. When we look at our drop-down menu, accounts payable. Accounts payable is a liability account we're going to use to record the debt that we owe that supplier. Right, and the amount that we owe them is $5,292. All right, now B, we're to assume that now we're paying the supplier, and we paid. It says up here that Travis Company paid for the merchandise within the discount period. All right, so if we're paying it, the first thing we're going to do is we're going to reverse out that payable because we no longer have a debt. All right, so the first thing we do is reverse out that payable. So we're going to debit our accounts payable, the $5,292. All right, we're paying. So the account that we're going to credit, if we're making a payment, the account we're going to credit, let's think about this, it's going to be cash. So anytime we pay a bill, anytime we pay a debt, we're going to be hitting our cash account. And again, cash is an asset. So if a debit increases assets, a credit decreases assets. So we're decreasing cash because we're making a payment. So we're going to credit cash $5,292. Check our work. There we go. So I'm going to click over here, show answer key. Just to kind of give a little more explanation. I'll let you guys kind of look at that screen, make your notes. Again, I also will be posting a PDF printout of all this information so that you will have a printout as well to utilize to help study for the final exam. All right, so let's move on to the next problem. All right, so the next problem. Now we have Marshall Supplies. It's a janitorial supply store that uses perpetual inventory system, and it wants you to journalize the following transactions. All right, so here again, we have where we purchased some inventory. We purchased inventory for sale from Tidy Wholesalers, and our total purchase amount was $8,500. But we also have a discount term. This time is a 1% discount if paid within 10 days. Okay, so 1% of $8,500 is $85. So 8,500 minus 85 is $8,415. So let's go ahead and hit that July 4th, and let's go ahead and record that entry. So we're obviously buying merchandise because it says right there we purchased inventory for sale. So we're going to hit our merchandise inventory. We're going to record it at the discount rate of $8,415. All right. Now we bought it on account, so we're going to credit that accounts payable. Okay, we're hitting our accounts payable for Tidy Wholesalers. All right, so that's got our transaction for July 4th completed. Now let's look at the 5th. Marshall pays express transfer $45 for the freight on the July 4th order. All right, so when you pay for the freight, 9 times out of 10, you consider that part of the total inventory. You're going to add that into your inventory total. So you're going to debit your merchandise inventory. And since we paid the bill, we're going to credit cash. All right, now let's look at transaction number for July 7th. Marshall buys an additional $11,985. All right, so $11,985 times 1% is going to give you a discount of $119.85. All right, so the total value of the merchandise inventory that we purchased is going to be $1,865.15. All right, so let's go ahead and hit that merchandise inventory account because we bought more inventory and we bought it on account. So we're going to go ahead and hit that accounts payable, And we'll go ahead and finish entering that amount in. All right. Now, the last thing. It says on July 13th, Marshall pays Tidy Wholesalers the balance due on both invoices. Okay. So we're making one payment, one big payment, and we're paying off both invoices. So first thing we're going to do is we're going to take both amounts that we posted to accounts payable. So the $11,865.15 plus the $8,415. All right. So that's going to give us a total of $20,280.15. And what are we doing? We're paying our debt. We're paying both invoices off. So when you're paying a debt, we take it out of accounts payable. So what we're going to do is we're going to immediately debit accounts payable. All right. We're paying that debt off. So when we pay that debt off, we got to reverse it off the books. So that's exactly what we're doing. We're reversing it off the books, showing it paid in full. All right. And when you pay a bill, well, you're going to credit your cash because you're reducing your cash balance. All right. Now, another thing I want you to look about and think about. So what were those discount terms? So discount terms was if you paid your invoice within 10 days. That first invoice was from July 4th. That second invoice was from July 7th. We paid both of them on July 13th. So based on those dates, we paid both invoices well within the 10 days. So we do not have to worry about not qualifying for the discount. We paid within the 10 days, so we get to keep the discount rate. Okay. Just check our work, make sure all of our calculations were correct. Okay. All right, so let's move on to the next problem. All right, this one's a little bit trickier. So on this one, what it's wanting you to do is it's wanting you to determine the cost of merchandise sold for August. All right, so based on the information they provided us, there is one way to do it, and it's the best way to do it. So I'm going to go ahead and click on show the answer key because it'll show the math and the calculations. It'll be easier for me to explain to you and show you how to do it. All right, so first things first. First thing I want you to do is I want you to do a side calculation. All right. In this side calculation, you're going to calculate total cost of merchandise purchased. Now it's asking you the total cost of merchandise sold. But before we can do that, we have to calculate the total cost of merchandise purchased. All right. So let's look at the information they provided us. They gave us the total amount of purchases for the month. They gave us the total amount of purchase returns, and they gave us the total amount of purchase discounts. So if you look down here, okay, in this little side calculation they have for us right here, okay. All right, we're going to look at what's in blue. All right, the first thing we do is we're going to record total purchases. Our total purchases, 257,540. All right, we're going to immediately subtract out of that our purchase returns of 11,560. So you see here, we subtracted that out. All right. And then we're going to subtract out our purchase discounts of 5,290. So our net purchases equals 240,690. All right. Next step is any freight in. All freight in, we must add in to our purchase cost. Remember, when we pay for the freight, we make that part of our inventory cost. So we have to add that in. So if you see here, the freight in of $3,830 is added in. So our total cost of merchandise sold, all right, is 244,520. So again, you take your total purchases, subtract out your purchase returns, your purchase discounts, add in your freight, and that gives you your total cost of merchandise purchased for the month. All right. Now we need to okay, another step. All right, lots of steps here. So we've got the big step. This is the big step done. This is the big step. All right, getting all this done is the big step. So the next part is easy peasy. All right, the next part is you're going to take that total cost of merchandise purchased and you're going to add it to your beginning inventory balance. You see up here that gives you a beginning inventory and an ending inventory. All right, we're going to take that total cost of merchandise purchased that we just calculated, and we're going to add it to our beginning inventory balance. And what that's going to give us, That's going to give us our total merchandise available for sale. All right. So we have our beginning inventory. We add it into our net purchases. All right. And that gives us our total merchandise available for sale for the month. And that equaled $341,360. All right. Now I promise you we're on the last step. This is the very last step. To calculate cost of merchandise sold, the last step you're going to do is you're going to come up here and you're going to find your ending inventory balance. Again, your ending inventory balance, your inventory balance as of the end of the month. And what you're going to do is you're going to tell me you're going to subtract that out. So we have our total merchandise available for sale for the month. We're going to subtract out our inventory balance at the end of the month. The difference between the two, that is your cost of merchandise sold. So in this problem, our cost of merchandise sold is $238,730. All right, next problem. Next problem, we are doing inventory. All right, and in this one problem, we're going to do all three of the cost flow methods of inventory: FIFO, LIFO, and weighted average. And in this problem, it's going to ask us, what is the gross profit? What is the cost of merchandise sold? And what is the ending inventory based on the cost flow method used? Okay, so the first one we're going to look at is A, first in, first out. What is first in, first out? First in, first out assumes that your first purchase, which would have been your July 3rd purchase, this purchase right here, this purchase is your first item sold. So in this problem, during the month of July, we purchased 3 units at a total cost of $108. Okay. We only sold one. We sold 1 unit at the end of the month for a sale price of $45. Now in the first in, first out, we're assuming that that one item we sold at the end of the month was the first item we purchased July 3rd. So again, using FIFO, first in, first out, it's assuming the first item sold was the first item purchased. The first item purchased was purchased on July 3rd. So your gross profit is going to be that sale price of $45 minus the cost of that item you purchased July 3rd of $35. So your gross profit is going to be $10. All right. That's your gross profit. Now it's asking you, what is the cost of your merchandise sold? Well, we sold 1 unit and we sold the unit that we purchased July 3rd based on the FIFO, first in, first out. So your cost of merchandise sold is going to be that $35 for that right here, because it tells you the cost. And we're assuming that that one item we sold was the one we purchased on July 3rd. Now, your ending inventory balance is simple. You're going to take the $108. That was your total cost of items purchased, and subtract $35. Okay. So your ending inventory balance is $73. Okay. All right. The next one, last in, first out. Okay, so last in, first out is opposite. It's assuming that the last item you purchased, which would be in this purchase right here, July 24th purchase, the last item you purchased is the first item you sell. Last in, first out. So last item purchased is your first item sold. So based on that understanding, the item we sold on July 28th for $45 was the item we purchased July 24th for $37. So $45 minus $37. So to get the gross profit, you take your sale price of $45, subtract out your cost of $37, and that gives you $8. Okay. Your cost of merchandise sold, well, it tells you right there is $37. So we just bring down 37. All right. What is your ending inventory balance? Well, your ending inventory balance, you take your total cost of 108 and subtract out 37, and that gives you your ending inventory balance. And that's going to equal $71. All right. The last one we're going to do is called weighted average cost. All right. So your weighted average cost is simple. you're going to take the average cost of all your units. So we bought 3 units at a total cost of $108. So you take 108, divide it by 3, and you get an average cost per unit of $36. It even did the math for you here. All right, so your average cost per unit is $36. All right, so to determine gross profit using the weighted average cost, you're going to take the sale price of $45 and you're going to subtract out the average cost per unit of $36. All right, so 45 minus 36 equals 9. I'm going to double check my math because, okay. All right, so what is the cost of merchandise sold? All right, well, it tells you right there, your average cost per unit is $36. So under the weighted average method, you would use the average cost per unit as your cost of merchandise sold. All right. How do you determine your ending inventory balance? All right, let's think about this 2 different ways. If your average cost per unit is 36, we had 3 units, we sold 1, so therefore we only have 2 units left. You can do it one of 2 ways: 36 times 2 or 108 minus 36. Either way, your answer is 72. So I'll go ahead and click on this. And I clicked on this because down here, it shows you the math. It shows you how the math was done. All right, so I wanted to be able to click on that so you can kind of pause the video if you need to, make any notes you need to be able to see the math, how it was calculated for each of them. All right. So let's move on to our next problem. All right, so now we're getting into internal controls. And we're going to be talking about internal controls. It says the following procedures were recently implemented at Pampered Pets, Inc. For each procedure, indicate whether the internal controls over cash is a strength or a weakness. Okay, so let's start with A. At the end of the day, cash register clerks are required to use their own funds to make up any cash shortages in the register. All right, I'm going to go ahead and click on. This is a weakness, okay? And I want to click on it because it gives some really good explanations down here as well, so that you can kind of start reading some of those explanations. So why is this considered a weakness? So requiring register clerks to make up cash orders from their own funds give the clerks an incentive to shortchange customers. That is, the clerks will want to make sure that they don't have a shortage at the end of the day. In addition, one might also assume that the clerks can keep any overages. Okay. So what it means by it gives the clerks an incentive to shortchange customers means that it's going to create an overage in their register. And so therefore, when they're counting the register in the day, if they show that they have an overage, they'll just pocket the money. All right, so that's a weakness. All right, and the next one, at the end of the day, an accounting clerk compares a duplicate copy of the daily cash deposit slip with the deposit slip obtained from the bank. That is definitely strength. In fact, that is common practice. All right, that is done in every place of business that I worked. This has been a common practice. All right, so let's look at C. After necessary approvals have been obtained for the payment of a voucher, the treasurer signs and mails the check. The treasurer then stamps the voucher and supporting documentation as paid and returns the voucher and supporting documentation to the accounts payable clerk for filing. Again, this is common practice, so this is definitely a strength. What it is the accounts payable person is not the person that signs the check. So we have a separation of duty. So we have a separate person responsible for signing the check and ensuring that the check matches the payment voucher, and they make sure that payment voucher is stamped paid before it's returned back to the accounts payable clerk for filing. So that's definitely a strength. And again, that is common practice. D, along with the petty cash receipts for postage, office supplies, etc., several post-dated employees' checks are in the petty cash fund. All right, this is definitely a weakness. Employees should not be allowed to use petty cash fund to cash personal checks ever. All right. In any case, post-dated checks should not be accepted. Post-dated checks represent a receivable from the employees. Okay. All right, so let's move on to the next one. All right, so this one is a bank reconciliation. It is wanting you to do a bank reconciliation. So it's a 3-step problem. The first one is to prepare the bank reconciliation. And the second one is to journalize any necessary entries. And the third one is if a balance sheet is prepared, what amount should be reported as cash. All right, so I'm going to go ahead and click on show the answer key so we can discuss how all this was set up. All right, so bank reconciliation and entries. The cash account for Norwegian Medical Company at April 30th indicated a balance of $11,670. The bank statement had a balance of only $13,640. Okay, so comparing the bank statement and the accompanied canceled checks and memos with the records revealed the following reconciling items. Okay, so we have 6 reconciling items. We have outstanding checks. We have a deposit of $5,120 made too late. So we have a deposit in transit. That's what B basically is, a deposit in transit. C, the bank collected $2,660 on a note with interest. So we need to record that on our books. A check for $770 returned with the statement had been incorrectly recorded. Okay. The check was for the payment of an obligation for a purchase on account. All right, so that's going to affect our accounts receivable. A check drawn for $40 had been accidentally charged by the bank as $400, and then we have a bank service charge for April in the amount of $50. So if we look here, we have the cash balance according to the bank, and then we have the cash balance according to the company's records, which would be the book balance. So we have the bank balance and we have the book balance. All right, so we started out with the bank balance, and it told us up here that the bank balance was $13,640. All right, so the first thing we need to do is we need to add that deposit. So we had a deposit that we recorded on our books that had not hit the bank yet. So we need to add that into our bank account. So we're going to show right here. We're going to add that deposit in. So we see the deposit added in. All right, now we had that bank error. Okay, that bank error. A check was drawn for $40, and it was erroneously charged by the bank as $400. All right, so in other words, they took out of our account $360 too much. All right, they should have only drawn $40 out of our account for that check, but they accidentally drew $400. So they owe us $360 back. So we see here, we go ahead and click on that bank error, and we're going to add that money back in. All right. Now, the last thing we have is we have to deduct our outstanding checks. So these are checks that us, the business, have written to other customers or vendors that have not cleared the bank yet. So they're considered outstanding. So we've already reduced that. We've already deducted those checks out of our book balance. So now we got to deduct those checks out of our bank balance because they haven't cleared the bank yet. So we have to subtract it out so that we can then reconcile our bank balance to our book balance. So if you see here, we started out with our balance of $13,640. We're going to add in the $5,120, add in the $360 that they owe us, and then subtract out the outstanding checks. Once we do that, our new adjusted balance is $14,210. Okay. Now we got to do the book side of the house. So the book side of the house, we started out with a balance of $11,670. All right. So the bank collected a note on our behalf, and a total for $200. The note was $2,520, and it included an interest payment of $140. So we're going to go ahead and we're going to add in that note plus interest of $2,660. Now, a check for $770 was returned with the statement that had been incorrectly recorded as $700. All right. So we have to deduct that error out. So in other words, the check was for $770, but we recorded it on our books for only $700. Okay, so we made that mistake. That was our error. So we've got to further deduct our account, that $70 that we didn't originally record when we reported that check. And then we have to deduct out the $50 bank fees, bank service charge. So we start out with 11,670. We add in that note that was collected by the bank of 2,660. We subtract out the 70 and we subtract out the 50. And once we do that, our adjusted book balance is 14,210, which matches our adjusted bank balance of 14,210. So we're now reconciled. All right. So the next thing we do is we have to look up here and determine what we need to record on the ledger. Okay. So the only thing that we ever have to record on the ledger when you're doing a bank reconciliation is any adjustments that are on the book side. Okay. We do not have to record if the adjustments on the bank side, we don't do anything to the ledger for the things on the bank side. Those are just things that are being fixed by the bank. Okay. So we don't have to make those adjustments. The bank has to make these adjustments. All right. So anything on the bank side are adjustments the bank makes, not us. All right. So the only adjustments we have to do as far as a journal ledger entry is anything that's on the book side. All right. So the first one we're going to do is we're going to look at the journal entry where we record the note that was collected. All right. So the total amount of cash we received for the note collected was 2,660. The face value of the note was 2,520, and the total interest payment we received equaled $140. So to record that on our books, we're going to debit cash for the amount of cash we received for payment. We're going to clear that note receivable by crediting the note receivable account, because again, a receivable is an asset. Assets are increased with debits, decreased with credits. We're showing this receivable paid in full, so we're going to credit note receivable for the face value of the note of 2,520. And then we have to record that interest, and that interest is considered a type of revenue. Okay, this is income, a type of income we've earned. So we're going to record it to interest revenue. And again, revenue is recorded with credits. So we're going to credit interest revenue for the $140. All right, so that's got that note and interest collected by the bank. All right, so that's got that covered. Next, we have the $70 error in recording the check and the $50 bank fee. All right, so the check payment was not recorded correctly. All right, so it should have been recorded as a payment of $770, but it was only recorded as a payment of $700. So we have to finish out recording that payment. So we have to go ahead and debit accounts payable, showing that amount that we paid. Okay, because we were supposed to pay $770. That's what the check was written for, but we recorded it as $700. So we have to finish out recording out the correct amount. So we got to go ahead and debit accounts payable for that $70 that we did not record, and because again, the check that we wrote to pay our debt was for $770, but when we recorded it on our books, we accidentally only recorded it as $700. All right. So we have to go ahead and record it as a debit to accounts payable for that $70 we accidentally forgot and left off. So it's going to be a debit to accounts payable for $70. And then we also have to record that bank fee, and that's just going to go under miscellaneous expense. So we'll add that in. So we have the $70 that we have to record as part of that payment that we left out. And then we have the $50 bank service charge. So we're going to end up actually decreasing cash for both of those, which is going to be a credit to cash for $120. All right, so that's it for the journal entries. The last thing it's asked us is if a balance sheet is prepared for Norwegian Medical Company on April 30th, what amount should be reported as cash? Well, that would be what your adjusted balance is, 14,210. So that's what your answer is for number 3. All right, so that is it for this problem. So let's move on to the next. All right, and this is the last problem. So we have, one moment. All right, so this last problem we're going to go over is a financial statement analysis, and it is where we are doing our cash to monthly cash expense ratio. All right. So we have Capstone Turbine Corporation, produces and sells turbine generators. The Capstone Turbine reported the following financial data, all right, for the recent year. So we had net cash flows from operating activities and cash equivalents. All right, so determine the monthly cash expenses and then determine the ratio of cash to monthly cash expenses. And then based on your analysis, do you believe that Capstone will remain in business? Okay, so the first thing first is let's do A. Let's determine the monthly cash expense. All right, so this is your cash flows from operating activities. In other words, these are all the cash flow used to pay your operating expenses. Okay, so and it's for the entire year. All right, so 8,641, and of course it's in the thousands, but that's not important. So 8,641. So to get the monthly breakdown of those total expenses, you would divide it by 12. Okay, so if you look down here, you see that 8,641 divided by 12 equals $720.10. So that is your monthly cash expense. So that is what you spend on a monthly basis for your operating expenses. Okay. All right. Next, it says determine the ratio of cash to monthly cash expenses. So you take your total cash and cash equivalents that you have at the end of the year, and you're going to divide it by that monthly cash expense. So if you see down here, we have our total cash divided by that monthly cash, and we have roughly 20 months. So we have almost 2 years worth of operating expenses sitting in our cash account. So without any additional revenue coming in, we can continue paying monthly operating expenses up to 20 months. Again, let me repeat that. So based on what our total cash and cash equivalent balance is at the end of the year, divided by our monthly cash expenses, all right, we have about 20 months worth of expenses sitting in our cash account. So again, without any additional revenue coming in, we could pay our operating expenses for 20 months. So based on that information, yes, Capstone Turbine will definitely be able to remain in business because they have more than 1 year's worth of operating expenses sitting in their cash account. So that is it. That is all of the practice problems that are going to be covered in your final exam. Again, there is going to be a PDF printout of these problems and of course this video, which will help you in studying and preparing for the final exam. So I wish you all the best of luck, and maybe I'll see you in future semesters.